We've now covered two techniques to put portfolio diversification into practice. They were diversifying across asset classes and secondly, assets within classes. This time, we turn our attention to diversifying across timeframes. And because assets can often be categorized into different market regimes in different timeframes, this is yet another tool to make diversification a reality. Stay tuned. So we're now on our third technique out of 4. And this is the concept of diversifying across different time frames in order to produce different trades across each of those. Now this of course could be with the same strategy, that is just maybe for example using indicators on different time frames. And what I found from my own experience is that often trading systems do work without any changes whatsoever when you trade them across those different time frames. So I've got systems that work on anything from the 5-minute time frame all the way through the time frames up until the 4-hour chart. And so this is a really great way as well of getting maximum value for all of that hard work you've put into developing the system in the first place. Now, a little word of warning here. There might be some correlation between adjacent timeframes. And what I mean by adjacent timeframes are any timeframes that are relatively close together. So for example, the M15 and the H1, or the H1 and the H4. However, what I found through my own personal experience is that there's still enough uncorrelated behavior to make this worthwhile. And the reason for this can easily be seen just by taking a look at some charts. Choose an asset and look at that, let's say on the H4 chart to start with. And often you'll find that that's in a particular market regime, such as an uptrend. But then as you go down a time frame, you might notice that the immediate behavior is more classified as a trading range. And of course, within a trading range, the price has to be going either up or down. And so very often you'll look at the time frame below, so for example the M15, and see that you're in a mini downtrend within that trading range. Now it's these different market regimes which means that your trading system, even though it's trading with the same rules, will be producing different trades within each of those timeframes. So once again, let's take a look at this in action. So here I've chosen to trade an absolutely identical trading strategy, one using indicators that were on the 5-minute chart, which you can see here on the left, and one using the 15-minute chart. And as you can see, the equity curves are relatively different. And although they both make a profit, as you can see from the blue equity curves, the strategy when traded in the 15-minute time frame made bigger drawdowns than that in the 5-minute time frame. But of course, when we talk about diversification, what we're actually looking for is the effect of those equity curves when trading them simultaneously in the same account. And here on the right is the equity curve of that combined mini portfolio. Now overall this looks fairly good. It certainly looks a lot better than the 15-minute being traded individually. But how does this compare to the 5-minute chart, which was actually quite a bit better than the 15-minute chart? Well, the best way to do that is to take a look at the individual metrics. So the left-hand column here is for pound New Zealand dollar in the 5-minute time frame, the central column for the 15-minute time frame, and then the right-hand column for the combination of those two into the same account. Now, the CAGR figure appears about halfway between the two, and that's exactly what we'd expect. But then in terms of the maximum drawdown, we can see that this is less than either of the other two accounts. And so when we combine those two figures together to give us this single reward over risk performance metric, we can see that this is substantially better. So whereas for pound New Zealand dollar in the 5-minute time frame it was 0.48, 0.44 in the 15-minute, when we combine them together we get a combined ratio of 0.68. And so yet again, another illustration of how diversification can provide these sorts of benefits. Now, just like I did for the previous two techniques where I went into the Darwinex platform to show you how we could see how traders on the platform are diversifying, let's do the same now for timeframes. Now, although it's impossible to identify the actual time frame of the charts that traders are using, we can look at information from the duration of their trades to get a kind of idea about the diversification they might have in place. So let me show you where you can find that information. So across here, as we've said before, these are the traders that have gained the most investors. But of course there are also other filters as you scroll down where you can get an idea of other accounts that are hosted on the platform. So let's take a look at this one here. Again, really nice equity curve. This particular trader has 177 investors in this particular account. And so again, he'll be earning success fees for that as he makes profit for those investors. But in terms of getting information about the timeframes, we can look at this Assets and Timeframes tab here and scroll all the way down to the bottom. Now, the green dots represent those profitable trades and the red dots represent the loss-making trades. But what I'm interested in is the y-axis here. And this tells you how long each of those trades was open for. And so down the bottom here, if we look at these trades, we can see that some of these were open for incredibly short periods of time. 30 seconds, 3 minutes 6 seconds, 2 minutes 32 seconds. But because this is a logarithmic scale, let's take a look at the trades at the top here. This one was open for 17 hours 42 minutes. This one here, 14 hours and 10 minutes. So although we don't know for sure, it's likely that this trader is trading different systems across different timeframes, potentially in order to get that benefit from diversification in order to hopefully reduce drawdowns on the equity curve and generally produce a smoother equity rise. In fact, as I'm speaking, I've just noticed that this trader's put a description here at the top, and they are actually saying that this strategy is multi-time frame and multi-asset, of course. So that just confirms what I identified from the chart. Okay, so hopefully you're finding all of this useful and it's giving you some ideas about how potentially you can diversify in your own trading accounts, often without too much effort at all. So if you've developed trading systems that are based on relatively simple rules, the chances of those working across multiple assets and timeframes is actually improved. Obviously, if you've designed systems that specifically target the behavior of an individual asset, then clearly that's not going to be possible. Please do feel free to take a look at the Darwinex platform for yourself, and you can look at all of the metrics that are available for each of these systems on the platform. So that's it for this time. Next time I'm going to be looking at the last technique for diversification that I'm going to cover, which is using multiple trading strategies. So please do remember to give me a thumbs up if you've got value from today. And now until next time, trade safe.